So, update on my trading style. I have spoken about this on my Instagram, but to catch up on YouTube, right now I haven't been using any indicators for quite a while. The last indicator that I had been using is the 9 EMA, which is a moving average. So, it basically kind of shows you a line that continues along with where price is directionally moving to. But since for probably a couple months now, or maybe like very recently, I have stopped using every single indicator. Really, over time, I've kind of like trickled down using fewer and fewer. So I used to use volume weighted average price, so VWAP. I used to use the 90 MA, that was the last one. And then I used to use the volume bars down here. So chart at one point did have a lot of all these lines. Over time, trading styles evolve. They are still very helpful in however you trade. But then I found myself kind of not relying on them as much, or kind of completely forgetting that they were there and not even watching them. So like one day I did end up turning off everything and then realized that, wow, everything I'm just looking at or how I'm trading is just strictly based on the levels I created, how I chart on my chart, and then just looking at the actual candlesticks to tell me, hey, is it price going up? Is it going down? Is it going sideways? Are we having any breakouts? Are we looking like price maybe a little weaker? I've been like kind of focusing on that to understand whether there is strength in the market. So with my trading style, I am basically looking at, top-down analysis, where's the trend direction, and then from there, which direction am I trading into for the morning for my scalps and day trades. And then from there, I will just kind of trail my stop to see how far price can go based on the trend that I see. To kind of go over just the change in this all the indicators that I had been using. If we turn them on now, this is something where you, as a newer trader, or maybe even as a seasoned trader, you may even like to use indicators for your strategy. It kind of depends on what you like to use it for. But I definitely would say like every indicator does show that, it's based on the candlesticks itself. So likely you will see some kind of correlation between maybe RSI, MACD, all these divergences, moving averages. It kind of basically is calculated based on the data that the chart shows. So either ways, it's telling you the same thing, but can be a good guide as you are in a trade. Maybe you like to use it as a stop loss. Maybe it's part of a moving average crossover, a bounce area that you like. So really depending on it, I wouldn't say that it's, I wouldn't discourage using it, but I would say don't rely on it, because a lot of the times, sometimes they are lagging. So if you rely heavily on that, you may only realize that, okay, I'm still holding on to this trade. Everything else looks like it's going bearish, but you're still holding on thinking that it's going bullish just because the indicator says it's bullish. Looking at this chart, we have this moving average. This is the 9 exponential moving average. This was one of my favorites for a very long time just because I used it for a stop loss, just telling me whether the trend is really strong. When price started to go sideways, it would tell me that price is weaker now. So that would kind of give me a good gauge based on the trend that day. And then this one is the volume weighted average price, so VWAP. This one is a good, you can use this really well if you are maybe, looking that price is above the level. Sometimes people will use it, only take calls above this area. And then when price is below VWAP, people trade puts, or, maybe there's a crossover between these two lines, and then that is a signal for entry. So depending on what you found to be helpful, I didn't really find VWAP to be that helpful, just because if we kind of look at how it's used, this blue line, you will see price cross in and out. So say that you are maybe bearish below VWAP, but it's going bullish, but it's kind of contradicting sometimes, or even if it's like really slanted, kind of more shallow rather than a very steep one, it kind of just shows you exactly what price is doing, except it's lagging. And then the last one I was using was volume, more towards the start of my trading career. But this one tells you basically what the volume is at that period of time. So whatever candlestick you're looking at, 2-minute chart, it basically tells you, hey, on this 2-minute candle, there was just a lot of buying, or just a lot of bulls in the market because it ended up green. But a thing that you don't realize is that just because these candlesticks are green or red does not mean that there was a lot of buying. Sometimes, yes, it went bullish, but it could also mean that maybe partially there's a lot of selling, but then price just ended up closing bullish. So there's selling, buying, but we don't know what's like the percentage of that. The candlestick will tell you whether it's really a stronger sell-off or a stronger buying pressure, just based on, is the body big? Is the wick longer? Is the wick above it, below it? That's going to tell you whether price was actually really bullish or bearish, even despite these candlesticks here. You can even see like this one was a very high spike in volume, and then it was basically the end of that really strong trend. So that wouldn't have even been a signal to tell you, hey, buy some more. It's basically happening at the end of the whole trend. This was the whole movement upward, and even from there did not have as strong volume as here. So that's why I wouldn't really rely on the volume to tell you, hey, you should buy once price spikes, because that spike could be the last bit of that buying or the last bit of the selling. Or you have this spike here, but it's kind of in the middle of consolidation. So I wouldn't rely on this volume, maybe as an assisted indication that, whatever analysis you did, it's confirming the volume that you wanted on the breakout or something. But based on indicators, you should never rely on them, because basically it's lagging. It's going to tell you exactly what price does, but only calculated after price moves. And honestly, I would, if you're in the phase where you are kind of relying a little bit more on indicators, it's just a journey you have to take. Throughout your trading journey, you're going to find that you may evolve over time. You may find that you may like to trade a certain way, or maybe you over time change that way. Maybe the strategy that you've always been trading kind of changes throughout the way as you discover better ways of trading, things that you want to add, things that you want to take away from how you trade. So it's really something where, I wouldn't say force yourself to just turn off all the indicators, because you're going to do exactly what you need to do for you to understand how price moves. But I would say over time, as you gain more experience, or you have more preferences, or you just have recognize a lot of different movements in the market, you may start to realize that, hey, maybe I don't need as many indicators, or maybe it doesn't serve me well as much anymore. So it's okay to evolve over time. I just would say just don't rely on it heavily, and don't make it okay, this is the only reason you're buying it, because everything could look like it's going bearish, but then there's a bullish indicator, and so it's kind of contradicting the overall trend. If you truly want to understand real price action, all you really have to look at is the market structure telling you that it's going upward or downward. Look at whether it's going sideways, or if price is, breaking out of any kind of resistance, right there, breakout, push up, break and retest, go higher. So you really just need support resistances, market structure, and then other than that, if you need a couple of indicators to assist you in the direction that you think it's going to go, then so be it. So it's up to you. Everyone trades very differently, so don't feel any pressure that you have to copy someone's exact strategy, because it's kind of personalized to what it works for them. You may have a different way of trading, and it may work for you. So then go with what works for you, and then if you can't find success in that, then continue with that.